All right, today we are going deep on a massive, real-world financial trade. And what's so cool about this is that it tells a story, a really fascinating story, about where some very smart money thinks the AI revolution is actually heading. Think of it like a financial detective story. We're going to follow the money and figure out the why behind a nearly $70 million bet.
So, let's set the scene here. It's early 2026. The market is just electric with AI hype, right? Stocks are going parabolic, things are volatile, and right in the middle of all that chaos, one single anonymous trader makes a move. And it's a move so big and so specific that you just have to stop and ask, what's going on here?
And I mean, look at the scale of this. Just let that number sink in. Over $69 million. That's the amount of exposure on this one single trade. This isn't just a casual bet. This is a statement. It's a declaration of absolute conviction that a specific company has a floor that's basically made of concrete.
And that really brings us to the core mystery we're going to unpack today. In a market that is obsessed with finding the next rocket ship stock, the next 10x return, why would somebody risk this much money on a bet that a stock won't fall off a cliff? What insight do they have that maybe the rest of us are missing?
Okay, so to crack this case, we have to start with the evidence. Let's first break down exactly what this trade is, what it looks like on paper, because the mechanics are the first clue.
So, the company in question is Celestica, ticker CLSP, and the trade itself is something called a short put. Now, what really jumps out here are these two numbers, the strike price, $145, and the fact that when this trade was made, the stock was trading way up at over $280 a share. So this trader is betting nearly $70 million that the stock won't fall more than 50% by May of 2026.
So what exactly is a short put? Well, the easiest way to think about it is like you're selling insurance. For selling these contracts, the trader collected about $1.4 million in cash right up front. That's theirs to keep. Now, if the stock stays above $145, they just pocket that cash. Easy money. But if it falls below, well, they're forced to buy the shares. But they get to buy them at that huge discount price of $145. In their mind, it's either free money or they get to buy a great company on a massive sale.
Okay, so that explains what the trade is. But now for the big question. Why? Why be so incredibly confident in that $145 price? Well, to get that, we have to dig into the company's story, because Celestica has gone through this quiet, secret transformation that's changed everything.
You see, you really have to think about two Celesticas. There's the Celestica of the past, which was what's known as an EMS company. Low margin, basically just a simple assembler, building stuff that other people designed. But the Celestica of today is an ODM, an original design manufacturer. They're a high-value design partner, actually helping to engineer the super complex hardware that powers the AI revolution. And that shift, that changes the entire game.
And this chart right here, this tells you everything you need to know. Look at that. 78% of their revenue now comes from their connectivity and cloud solutions division. That's the engine room. That's the part of the business that's building the specialized gear for AI data centers. This isn't some little side project. This is their growth story now.
All right, so we've got the business transformation. What's the next big clue in this mystery? Well, it's Celestica's incredibly close, symbiotic relationship with one of the biggest, most powerful companies on the entire planet.
For a little while, there were some rumors floating around, some market chatter that caused the stock to dip, and Celestica's management came out on their earnings call and just shut it all down with this incredibly strong statement. They made it crystal clear. They are the preferred manufacturing partner for Google's custom AI chips. This isn't just a supplier relationship. They are deeply, deeply integrated.
And if that quote was the statement, then this number, this is the motive. Google's parent company, Alphabet, is planning to spend an eye-watering $180 billion on capital expenditures in 2026. A massive chunk of that is going straight into building out AI infrastructure, and Celestica is standing right there with a giant catcher's mitt ready to build the custom hardware that money is paying for.
So when you put those two pieces together, that deep partnership and that torrent of spending, Celestica stops looking like just another speculative tech play. They become something far more durable. They're basically the company building the toll booth on the new AI data highway.
And this is so important. That $145 strike price, our trader didn't just pull that number out of a hat. Look at the stock's journey. You can see right here that 145 was a key support level, a base that was built way back in July of 2025.
That was before the biggest, craziest wave of AI hype even started. They're betting the stock won't even fall back to its pre-euphoria level.
And we're not just talking about putting together old tech. Right now, probably the single biggest bottleneck holding back AI is networking speed, how fast data can move between chips. Well, Celestica is the leader, the go-to engineer for the next generation of that technology, which is absolutely essential to make these new AI systems work at all.
So, we've heard the story, but do the numbers actually back it up? Oh yeah, a 43% return on invested capital? I mean, for a manufacturing company, that is almost unheard of. It basically means for every single dollar they put back into their business, they generate 43 cents in profit. They are an incredibly efficient cash printing machine, and that lets them fund their own huge expansion.
Okay, time to put it all together. We've seen the business pivot, we've seen the Google moat, we've seen the incredible financial strength. Now we can finally decode the mystery of why our trader sees $145 as an unbreakable structural floor.
And you know what? It all boils down to some pretty simple but really powerful math. Remember, if the trade goes wrong and they're forced to buy the shares, they get them at $145. Well, based on what the company is expected to earn in 2026, that means they'd be buying the stock at a price-to-earnings ratio of just 16.5.
And just to put that number into perspective, look at this. A PE of 16.5 for Celestica. Compared to its direct peers in the AI hardware space, like Broadcom and AMD, it's not even close. It's not even in the same ballpark. For a company with this kind of growth and this kind of partnership, that valuation isn't to discount. It's an absolute steal. That is their margin of safety.
So, there you have it. The mystery is solved. This wasn't some wild gamble. The trader's entire $69 million thesis rests on these 4 rock-solid pillars. First, a hard valuation floor, where even their worst case is a huge win. Second, a structural moat thanks to their Google partnership. Third, incredible cash flow that proves the business is working. And fourth, they're basically capitalizing on other people's fear, getting paid to wait for a price that represents an unbelievable bargain.
Which leaves us with one last big question to chew on. While almost everyone out there is chasing the next flashy AI application, maybe this massive bet suggests that the smartest, most durable investment isn't in the product at all, but in the essential hidden plumbing that makes the whole thing possible.